Hey everybody, welcome back to the channel. Today we are talking about Tom Lee, who is what is referred to as a perma bull, someone who believes in the optimism of the market, the dynamism of the market, I definitely butchered that word, and someone who just genuinely believes that, look, if things are going good in the macro, because he is a macroeconomist, he's not looking at the DCFs or like the micro of an individual stock. He's looking at what's going on in the macro, what's going on with supply chains, inflation, interest rates, and how can I create a predictive analysis based upon all of these factors that I'm putting in together to be able to predict whether stocks are going to go up or whether they're going to go down. So he is someone who's really gained popularity over the past 2-3 years because he's used a lot of logical arguments to try to make a bull case for stocks. And obviously in the past 2-3 years, we've had a pretty good bull run. Now, has he always been correct? No. But when he does come on CNBC, he offers a fundamentally different perspective than a lot of the fear mongering that exists on that network and in general in the media, by just saying, look, here's the actual facts about what's going on in the market. And if these facts continue to be true, we should expect the market to go up. And as a result of that, he's earned himself a pretty big name just talking about stocks in general. So he just did a recent interview that we're going to look at in a second. And this interview really caught my eye because essentially he was arguing about the tax day. And so as you can see the title of this video, hopefully the passing of tax day ends indiscriminate selling. And the idea that he's talking about here is the fact that when you have millions or hundreds of billions and trillions of dollars going into the government, it's not going into the stock market. And as a result of it not going into the stock market, it is something that we need to discuss. So let's get into it right now, and we will talk about this.
Lee, who says it's no surprise stocks are struggling recently, and Uncle Sam is to blame. He joins me now at Post 9. It's all Uncle Sam's fault, tax day, and then everything's going to be cool?
I hope things get better, but yes, this year, April 18th is tax day. It's an extraordinarily big tax hit. We calculated what we estimate Americans owed. It's about $828 billion, excluding crypto. Crypto is probably another $125 billion in taxes owed. So about $1 trillion went to Uncle Sam today.
And so, but you think literally, like you get today out of the way, and then there's a noticeable and notable impact in the market?
Yes. We looked at years where the market was strong. The 2 weeks into tax day, our markets are weak. There were a lot of folks caught off guard because they thought they had until October, and of course they don't. They have April 18th. So there was a bit of a frantic push, and hopefully this takes away indiscriminate selling.
So that's one of the first things to talk about, right? A lot of people, including my dad, who got a pretty heavy tax bill, he has to pay it off in installments because he just doesn't literally have the cash to pay it off right now. He's one of those people that Tom Lee's talking about. I'm one of those people. I just paid my fair share of taxes like literally 2 days ago. And so the argument he's making is that when people have to pay those taxes to the government, that money has to come from somewhere. And if you're invested in the market, if you're invested in bonds, stocks, etc., a lot of times you have to sell some of the assets you have because, I mean, some people keep cash on hand, but I think a lot of people also just don't want to keep cash on hand because they're afraid inflation is going to ruin the value of their money anyway. So they'd rather put it into assets. Assets, what are the most easiest assets? Stocks, right? I could put it into Tesla, put it into AMD, Nvidia, Facebook. Companies that I know that are going to be here for the long term. So when you have that money in assets and you need to pay a $10,000 tax bill, you need to get those $10,000. And if you have no $10,000 on cash, what is that going to do? It's going to create massive selling of pressure across the entire United States on the market, and also selling pressure on crypto because you have to pay that. You have to liquidate some part of your portfolio to be able to pay taxes, and you're gonna have to sell what you have to sell, and then you're gonna have to take the rest of the money that you have and you have to put it into the government, right? Put it into taxes. Now, we've all collectively agreed as a society that it is better to put money into the government over public or private entities or companies. And, it might seem counterintuitive because like those public, private entities, those companies create jobs, they create economic prosperity, they create productivity, they create goods and services. These are all things that are valuable for an economy. But obviously we also need public roads and bridges and infrastructure and healthcare. Like there's so much stuff, I went to public school, so I am not ever mad about paying taxes. I think everyone needs to pay taxes. I just wish there was more transparency. So if I pay $10,000, I would like to know, somewhat of the percentage breakdowns of where that 10,000 is actually going. Now, I know the government is bureaucratic. I know it's complex. And I think most people would just appreciate being able to pay taxes and know where the money's going versus just like not pay taxes at all. Because obviously, we want policemen, we want teachers. And all of those things are funded by our taxpaying dollars. Tom's argument is that if we have to pay those taxes, then we can't put that money into the market. And now that tax day is over, now that we put $1 trillion into the market and the market is, and that selling pressure has gone from the market and we've gotten that money out of the system, we have a much better chance to bring more money into the system now that people are able to make money and that money doesn't have to go into taxes.
Okay. We have to discuss this tweet of yours where you agreed with somebody. And honestly, I saw this over the weekend. And I was like, what? I was like, what is Tom talking about? So I came in today. I was like, we got to get Tom Lee on. A gentleman by the name of John Carter tweets the following: the increasing shift out of financial assets into hard assets will soon turn into a panic move. And you said agree 100. And I'm like, wait a minute. Tom Lee comes on the show and he's bullish and he says the lows are in for the year. And now you agree 100 that there's going to be a panic move out of financial assets. I'll let you explain how that makes sense.
Yes. Well, because not all assets are equities. There's a lot of financial assets that are terrible inflation hedges. Americans today own $55 trillion worth of bonds. And they are going to get their quarterly statements. Bonds are down 7%. 25% of all 10-year periods since 1880, bonds have had a negative realized return. We're probably entering another decade. So there is going to be this, we believe, a panic out of bonds. It'll go into income-generating real assets. And a big chunk, we think, will be TINA, which ends up in the stock market.
So that's something really important to analyze right there. He's saying that Americans own $55 trillion of bonds, and when they get their quarterly reports, they're going to see that bonds are down negative 7%. And he's saying, really, historically, bonds have not performed that well in comparison to high-growing assets like stocks, right? So TINA, there is no alternative. That is the term that I just learned a couple weeks ago as well, so if you didn't know that, that's okay. There is no alternative other than stocks. So his argument is that when Americans see that the money that they've put their that the financial assets they've invested in that are not growing, which are bonds that are actually deaccelerating. Stocks are going down as well, but like there's a different relationship between stocks going down because it'll come back. There's quarterly earnings. There's like potential for these companies. With bonds, it's just going down. It's going down. There's just, macro inflation, supply chains, all interest rates, all of this stuff sucks the crap out of bonds. So at that point, his argument is like, well, if people start recognizing that there's going to be a decrease in bonds, there's going to be a panic out of bonds. And then the question is, where do you put your money? Gold, maybe. Gold was $1,000 in 2010. It's like $1,800, $1,900, 2020. It's barely doubled over 10 years. So like that's not the best asset you want to put your money into. If you keep cash, there's going to be inflation. NFTs, good luck. Crypto, very volatile. Most people should not be investing in crypto because you have no idea where it's going to go. So it's kind of just like, well, stocks, the S&P, that's the proven asset that makes sense. So TINA, there is no better alternative. Tax day is gone. Bonds are decreasing in terms of their negative realized returns that people are getting. Where else do you put your money? Probably into stocks.
So I don't think people are going to sell stocks to buy real assets, but they probably will sell a lot of bonds.
So you're talking specifically about the bond market and money coming out, because it doesn't say that. When I read this, I was like, what?
That's right. And I probably intentionally left it a little vague just because, it's the weekend. I was having a little fun.
Okay. You knew I was going to call you and be like, what in the world is this? In all seriousness, you do have people suggesting that there is an alternative, that TINA is no longer TINA, that maybe bonds are an alternative to stocks.
It's getting to be very tricky now because we have inflation that is quite elevated. We don't know if it's going to cool. Hopefully, that's our base case, that it cools. And we know that bonds yields have moved to a level that people might want to actually own some bonds. But the reality is if rates do creep up, so we have positive real rates, meaning the 10-year goes towards 4 or 5, anybody who owns that $55 trillion bond complex is going to lose another 10%. So you're talking $5 trillion of realized losses if people don't rotate out of bonds.
So his argument is, again, if bonds actually start going up to this 4 or 5% real rates of returns, then at that point, there's going to be a massive sell-off because you're going to realize, wait, we're losing so much money in bonds at that point, which means TINA, right? There is no better alternative. And that's the question of this market. Tax day is gone. Bonds are giving you negative realized returns. Stock market is bad, but stock market has a chance to get better if inflation, as in Tom's base case, starts to cool down. So we're at 8.5% of the CPI. Let's say that gets to 6.5 over the next 4 months, and then it gets to 5.5. The market is going to realize, oh shoot, inflation's going down, which means there's no reason why interest rates have to be hiked so high, which means we can put our money back into high growth tech stocks because, if interest rates are not as high, then that means, the valuations are not going to compress as much because analysts are not seeing that these companies are not paying more for future cash flows in the present, which means their valuations should tend to be more bullish, right? Like that's the whole nature of it. When interest rates go high, you're like, okay, the cost of borrowing capital and generating capital is going to be more in the future, which means I have to pay less right now valuations compress, stocks go down 60, 70% that we've seen in the past couple months, because people are not willing to pay those valuations anymore because they know it's going to be hard to live up those valuations when interest rates are high. So if that paradigm changes, now that tax day is gone, the macro gets better, inflation goes down, supply chains start easing up, and the Shanghai lockdowns are making it really bad for supply chains. I mean, there are a ridiculous amount of ships that are just stuck at bay because they can't load into Shanghai because there's a COVID lockdown, so they can't offload their stuff, which decreases the productivity of those ships, the supply chains, there's bottlenecks, etc. Things are still pretty bad right now. I think it's going to take the next couple months to see if we make any progress, along with hopefully COVID not increasing. But if all that stuff turns out to be correct, and bonds are giving you negative realized returns, then TINA makes sense. I mean, like, there is no other asset to put your money into. It would have to be the stocks, which means that theoretically could, potentially save us from a recession if people just keep investing in the market. So those are my thoughts. Let me know what you guys think about Permabull Tom Lee. He's someone that I look to in terms of getting his perspective on the bull market, and there are those other people that I look to get perspective on the bear markets. I think it's very interesting to have both of those perspectives interplaying. Tom is someone who's always very logical. It's not someone he's being very hyperbolic. He's not promising 50% cake or anything like that. It's not a dig at Kathy. It's kind of a dig at Kathy. But the point is, he's more logical in his assumptions, and you kind of try to understand where he's talking about when it comes to the market. So thank you guys for watching. Let me know your thoughts on Tom Lee in the comments, and I will see you guys on the next one. Bye-bye.